Hi, this is Nick Pollard, and this is the most recent signals report. This is our monthly report going over our economic indicators. So, kind of to start off, here's the summary of the indicators. Really, the only change from last month was a shift to overweight large cap from a reading that was favorable towards large caps. The models remain overweight equities as compared to fixed incomes. Style remains neutral between growth and value. Risk appetite is in neutral territory. This is the fourth month in a row in neutral territory, following an extended period in defensive territory. And finally, market crowding remains in neutral territory. So again, this is an indicator that has at this point been in neutral territory for some time. So to dive a little bit more deeply into these indicators, first up, I'm going to talk about the style indicator, the Cirrus style oscillator. It is now in neutral territory following a period in the summer where it was favoring growth, but it pretty rapidly declined. And so, one of the things about the current market is that we believe that that currently the profit cycle is slowing, following the pretty rapid acceleration that accompanied the global reopening alongside the massive stimulus put into the economy during the pandemic period. And so, we see this slowdown, but by the same token, in recent times, we've seen this very strong commodity/cyclical run. So, traditionally, value indexes or value factors have been constructed to have quite a few cyclicals, so financials, energy, materials, industrials, traditionally, as the economic cycle slows down, these companies, as they're tied to the real economy, suffer as a result. On the other hand, there are still some dislocations following the pretty strong growth run that we've seen over the past 10 odd years. So as a result, the indicator is sort of mixed in that the signals that suggest a mean reversion or slowdown of the profit cycle are pointing towards growth, whereas some of the other signals are pointing towards value. Finally, I wanted to talk about the CPQ, our measure of market polarization. And this chart on the left is a time series of the CPQ, which shows that there's currently a 12% discount for large cap momentum stocks as compared to the broader economic universe. Most of the time, what you'll see, in fact, is a pretty large premium in favor of the momentum basket over the broader universe. In fact, if you look at this chart, you can see that there's very few periods where we've seen such an extended cluster with large cap momentum trading at a discount. What causes this? A lot of this is because of the rotation from more speculative consumer discretionary and technology stocks towards energy as a result of the commodity rally, alongside defensives and consumer staples, as well as a rotation within healthcare from more speculative stocks such as Moderna to more defensive managed care stocks and more defensive larger pharmaceutical companies. Again, if you were to look at the same basket 12 months ago, you would see a much higher proportion of technology, consumer discretionary, and much fewer consumer staples, energy, etc. That wraps up this overview of the signals report. If you go online, you should be able to get the full report with a full rundown of all the indicators. Thanks.